Breaking news tonight. The global economy has been rocked by a $2 trillion shockwave as Australia becomes the first major Western economy to ditch the US dollar for the Chinese Yuan in all future trade with Beijing. The announcement has triggered market turmoil, political outrage in Washington, and celebrations in Beijing, with experts warning this could mark the beginning of the end for America's financial dominance. Australia's Prime Minister confirmed during a joint press conference in Canberra that the country's entire trade relationship with China, its largest trading partner, will now be settled in yuan instead of US dollars. The deal covers more than $200 billion worth of goods and services annually, from natural gas and critical minerals to agriculture and education services. The global economy is evolving, and our trade systems must evolve with it, the Prime Minister declared. Pricing our exports in yuan reflects the reality of Asia's growing economic power and ensures stability for Australian businesses. For decades, the US dollar has served as the backbone of global trade. More than 80% of international transactions are conducted in dollars, giving Washington unparalleled power to enforce sanctions, control financial flows, and borrow cheaply from global markets. But this decision represents a dramatic crack in the system. Australian officials say the shift will shield exporters from dollar volatility and strengthen ties with China, which buys more than one-third of Australia's exports. Behind closed doors, sources reveal the move was accelerated by growing concerns over U.S. debt levels, inflation, and sanctions policies that have pushed many countries to consider alternatives to the greenback. The immediate market reaction was chaotic. The U.S. dollar index fell nearly 3% in a single day, its sharpest drop in years, while the Chinese yuan surged to its highest level since 2015. Wall Street bank stocks slid as analysts warned that if more countries followed Australia's example, dollar demand could collapse, raising U.S. borrowing costs and weakening its global leverage. In Beijing, the news was greeted with triumph. State media hailed the agreement as a historic breakthrough against Western financial dominance and claimed the yuan was now on its way to becoming a true global reserve currency. Washington, however, reacted with alarm. A U.S. Treasury spokesperson said the administration was deeply concerned about the implications for global financial stability, while several senators accused Australia of handing China a geopolitical victory at America's expense. Global economists warn this could spark a de-dollarization wave across Asia, Africa, and even parts of Europe. Saudi Arabia, Indonesia, and Brazil have already signaled interest in conducting trade in non-dollar currencies. If this trend spreads, the dollar's share of global reserves, already at its lowest in decades, could shrink even faster. Financial commentator Sarah Lin told Bloomberg, "This is not just an economic story. This is a geopolitical earthquake. The dollar has been the pillar of U.S. power since World War II. If that pillar cracks, America's influence over the global economy will never be the same." The political firestorm ignited by Australia's decision spread rapidly across Washington, Beijing, and global capitals. Within hours, lawmakers on Capitol Hill accused the Biden administration of failing to protect the dollar's supremacy and warned that America's economic leadership faced its biggest threat in decades. Republican Senator Mark Collins called the move a betrayal by a close ally and demanded immediate diplomatic talks to prevent what he described as the slow death of the dollar. He argued that Washington had spent decades defending the Western financial system, only to watch partners like Australia hand China the economic keys to the future. Democrats were equally alarmed, though more cautious in tone. Some urged President Biden to convene an emergency summit with Australia, China, and other key trading partners to address growing concerns about global monetary fragmentation. Privately, however, administration officials admitted the U.S. has limited leverage to reverse this trend without alienating allies further. Beijing, by contrast, wasted no time celebrating the victory. Chinese state television ran nonstop coverage of what it called a historic milestone for Asian economic independence. A foreign ministry spokesperson declared, "The era of one currency dominating world trade is ending." More countries will now join the yuan trade-era financial markets echoed that sentiment. Analysts at HSBC predicted that other Asia-Pacific nations, including Indonesia, Malaysia, and possibly even South Korea, might soon consider shifting portions of their trade into yuan. Each move, they warned, would chip away at the dollar's role as the world's primary reserve currency. Economists outlined three major risks for the U.S. economy if this trend continues. First, demand for U.S. Treasury bonds could fall sharply as central banks diversify away from dollar holdings, forcing Washington to borrow at higher interest rates. Second, the power of U.S. sanctions would weaken if adversaries could bypass dollar-based systems like SWIFT. Third, American consumers could face higher prices if the dollar loses value in global markets, making imports more expensive. Wall Street reacted nervously. Goldman Sachs issued a note calling Australia's decision the single most important shift in global trade finance since the creation of the euro. Bank stocks fell for a second consecutive day as traders bet on a long-term decline of dollar dominance. Back in Canberra, Australian officials defended the decision as pragmatic economics, not geopolitics. The finance minister told Parliament that settling trade in yuan would reduce currency risks, lower transaction costs, and reflect the reality that China is our largest trading partner. Critics in Australia, however, voiced national security concerns. Some lawmakers warned that closer financial ties with Beijing could make Australia vulnerable to Chinese political pressure in future disputes. "We're strengthening our economy today," one opposition leader argued, "but what happens if relations with China sour tomorrow?" Meanwhile, energy and commodity markets reeled from the news. Australia is one of the world's largest exporters of liquefied natural gas, coal, and critical minerals like lithium. Pricing these resources in yuan instead of dollars will force global buyers to adjust contracts, currency reserves, and risk calculations, a process likely to inject months of volatility into financial markets. As one analyst at the London School of Economics put it, this is no longer just about trade. It's about power, influence, and the possibility that we are witnessing the early stages of a post-dollar world. As markets absorb the shock, analysts warned that Australia's decision could trigger a global chain reaction unlike anything seen since the creation of the euro. For decades, the US dollar has anchored the world economy, but experts now say this might be the first major crack in the system, a moment historians could one day point to as the beginning of the post-dollar era. One immediate risk comes from the domino effect. Countries like Indonesia, Malaysia, Saudi Arabia, and even Brazil have already expressed interest in diversifying trade settlement currencies. If just a handful of major energy exporters follow Australia's lead, the dollar's role in global oil and gas markets, long considered untouchable, could erode rapidly. A second risk lies in U.S. sanctions policy. Washington has relied on dollar dominance to enforce economic penalties on adversaries, freezing access to dollar-based systems like SWIFT. But if trade increasingly moves into non-dollar financial networks, America's ability to isolate countries like Russia or Iran will weaken dramatically, reducing its geopolitical leverage. Economists also warn about U.S. debt and inflation pressures. For decades, foreign governments recycled their trade surpluses into U.S. Treasury bonds, keeping American borrowing costs low. If demand for dollars falls, so does demand for treasuries, forcing Washington to pay higher interest rates to finance its debt, a scenario that could worsen inflation and budget deficits at home. Meanwhile, China is moving fast to institutionalize its advantage. Beijing has been promoting the yuan in Africa, Latin America, and the Middle East through currency swap agreements and digital yuan pilots. Some analysts predict the next step could be a BRICS-backed reserve currency designed explicitly to challenge the dollar in global trade. Global investors are taking note. Hedge funds have begun increasing holdings of gold and alternative currencies while trimming long-term bets on the dollar. Commodity markets, particularly oil, gas, and critical minerals, now face the possibility of being priced in multiple currencies for the first time in modern history. Back in Washington, lawmakers are divided on how to respond. Some demand urgent diplomacy to prevent allies from joining the so-called De-Dollarization wave. Others call for monetary reforms, such as strengthening the digital dollar or tightening fiscal discipline to restore confidence in U.S. financial leadership. But perhaps the most worrying question is psychological. If markets, governments, and corporations begin losing faith in the dollar, its decline could accelerate faster than anyone expects. Confidence, once shaken, is hard to rebuild. As one veteran currency strategist told Reuters, The dollar has been the backbone of U.S. power for 80 years. If that backbone cracks, the entire geopolitical order shifts with it. And so tonight, as the world watches this financial earthquake unfold, one question looms. Is this the beginning of the end for the US dollar, or just the first tremor in a much larger economic storm yet to come?